So good morning, everyone. So I think this week is actually marks the fourth week that we're into our accounting, so BA 99.1. And honestly, chapter 4 completes the whole accounting cycle. So in chapter 1, we got a crash course on what accounting is. On chapter 2, it was all about the recording process. And then chapter 3, we took a deep dive in terms of figuring out how to adjust the entries based on certain transactions in the form of accruals and deferrals. So now everything actually comes into a full circle in chapter 4, wherein today what we really want to discuss is now we're going to be completing the accounting cycle, or what we call closing the books. So for today's concept lecture, basically we broke it down into 6 learning objectives under our BAA framework. So under the first part, basically again, we're gonna be taking a step back and broaden on our understanding of our business context. So basically, we're gonna be trying to tie up everything, all of the steps that we've been doing for the past 3 chapters in the first learning objective. So we'll be able to identify the required steps in our accounting cycle. And then from there, we're gonna be introducing a new tool called the worksheet. So actually, it's kind of similar to like your advanced transaction analysis all the way to your trial balance. So this is something that hopefully would make it easier for us in terms of solving or even creating for our financial statements. And then once we're clear in terms of the previous steps that we've already learned in the past 3 chapters, we move on to the remaining steps that we haven't discussed. So for accounting for transactions, we're going to be taking a deep dive in terms of the ending process. So what happens at the end of an accounting period, and what do we mean by closing the books? And in relation to this, we're also going to be taking a closer look at what we call the post-closing trial balance. And then finally, the last 2 learning objectives would be looking at the different journal entries and also what we call the classified statement of financial possession. So now that we're clear in terms of the different parts of our lecture for today, we can begin with our first learning objective, which is again the accounting cycle. So from here, basically what we really want to do for this learning objective is to look at it step by step. What are the required steps from the initial recognition all the way to creating our financial statements? And way back in our very first lecture, we mentioned that there are actually 3 major phases in accounting, right? So identify, record, and communicate. So again, identifying is just identifying which transactions to record, which one of these would be economic transactions that we need to take down, and then differentiating from like personal transactions or events that are separate from our economic entity. And then the second phase would be how to actually record for these economic events. So we classify them into different journal entries and then summarize them into our ledger accounts, right? In our T accounts, and ultimately summarizing them into our trial balances, be it your unadjusted or your adjusted. And then ultimately, by using our trial balance, we're able to communicate the important information in the form of financial statements, your income statement, your statement of changes in owner's equity, and ultimately your statement of financial possession or your balance sheet. So taking a look back at our journey, so actually sobrang bilis lang nung 3 weeks that gone by. So level 1, we cleared it perfectly given that we really performed well in our first quiz. So again, level 1 was all about our transaction analysis roadmap. So coming into accounting, wala pa tayong alam. Basically, the very first thing that we wanted to do was just to analyze the economic transactions. And then from there, using the tool advanced transaction analysis, we were able to segue into what the end product of accounting, which would be your financial statement. So we discussed your income statement, your RE, and then your balance sheet. In the following week, in level 2, we took a deeper dive into how actually accountants record the process, right? So from the advanced transaction analysis, which is very useful, but it's really more for people to just appreciate the accounts. The more correct procedure is actually to, number 1, create journal entries. And then from there, post to our T accounts. And then ultimately creating our trial balance. And then from there, again, making sure that we create our financial statements, right? And then finally, last week, basically we entered level 3, wherein, okay, we understand that you have to journalize, that eventually you'll have to post. But then apparently the one that we've been learning is actually unadjusted trial balances, because we have to take into account that there are certain transactions that are not reflected in our trial balance. So this unadjusted trial balance may not contain up-to-date information. And therefore, our main focus last week was creating adjusting entries, and then from there, creating our adjusted trial balance. And then ultimately, again, deriving it back to creating our financial statements. So now that we're in week 4, we finally end the full accounting cycle, right? And the full accounting cycle, even though it's broken down into 3 phases, it's also broken down into 9 required steps, right? So what are the 9 required steps? So first is basically analyze the business transaction, right? Step 1. So basically, in all of our exercises, usually information will be given. What would be the entries? What would be the economic events that's happening with a certain company at a certain period, right? And then using those information, the second step is basically for every economic event, we create a journal entry, right? So for every transaction, we create journal entries. So if there are 11 economic events, there are 11 transactions, then we expect to make 11 journal entries for the given period. And then once we're done creating our journal entry, the third step would be to summarize them. So we post to our ledger account. So if that was a per transaction basis, using our T accounts or even our more formal ledger accounts, we summarize them on a per account basis. So basically from the journal entries, we plug it into our T accounts, right? So that's step 3. Step 4 is that we prepare our unadjusted trial balance using our T accounts. So in essence, we just categorize them into debits and credits to show that they are perfectly balanced, right? Double entry accounting system states that all of our debits or our left-hand side should equal our credits or our right-hand side, right? And then ultimately, after unadjusted trial balance, we learned last week that apparently that might contain not up-to-date information. And therefore, we learned how to adjust. So there are certain adjusting entries that we learned. So in the form of deferrals, in the form of accruals, right? So these are 7 additional entries on top of the 11 that we created in that period. And then, therefore, we plug in our adjusting entries to the unadjusted trial balance to ultimately come up with an updated version of our trial balance that now we call the adjusted trial balance. So, and then ultimately, using that adjusted trial balance, we created our income statement, our changes in equity, and our balance sheet or our statement of financial position. So right now, we've actually completed and we've actually hopefully mastered the 7 steps out of the 9. And therefore, the remaining 2 steps that we're going to be discussing today would be journalizing and posting what we call closing entries, given that what we're going to be discussing later would be closing the books. And then finally, creating our third version of our trial balance or our post-closing trial balance, right? So in summary, again, the accounting cycle is broken down into 9 required steps, right? And then as you can see, we also color-coded these 9 steps because we wanted to take note parang how often or how frequent do we actually do the certain step. So for posting, so basically from analyzing the business transaction, creating journal entries, and posting to ledger accounts, this happens usually on a daily basis, right? And then in terms of our summary step, basically, this happens periodically depending on company directive. So this can happen monthly, this can happen weekly, or this can happen quarterly, right? So basically, we prepare the trial balances, the adjusting entries, and then the financial statements periodically. And then finally, to mark the end of a period. So usually a lot of companies, they follow either calendar year or fiscal year, and therefore closing entries and post-closing trial balances usually happens annually, right? So again, this would be our whole picture of the 9 required steps in the accounting cycle. So basically, our lecture for today is broken down into 2 parts, right? So the first part is we're gonna be taking a closer look or reviewing the steps 4 to 7 in the lens of what we call a worksheet. And then after the worksheet, basically we're gonna jump into the last 2 steps so that we can finally complete our accounting. So at this point, just wanted to ask if there are any questions with regards to the first learning objective. Yeah. So kindly type in the chat na lang if there are some questions. Okay. Parang I kind of see none. Okay, perfect. So if everything's clear, so that was our overview, right? So again, we're gonna be taking a closer look at steps 4 to 7 and using another tool that we're going to be introducing, which would be the worksheet, right? So the first question is, what is a worksheet? So in essence, a worksheet helps provide your financial statement information at an earlier date. So in a sense, your worksheet, it looks like your parang working paper or parang working draft that eventually, once you complete your worksheet, you can actually create your financial statement. So this also serves as your basis for your financial statements, like what I mentioned, instead of the adjusted trial balance. However, I want everyone to note that the worksheet actually is merely a tool to organize our data at an earlier date, right? So it's an optional tool. Ang required is our adjusted trial balance, but then it would be nice if it would be in the form of worksheet. So I'm not sure if you're familiar, pero usually, when I was preparing for BA 99.1 back in college, the very first thing that I bought was this columnar ba yun? Yung parang yellow sheet na sobrang daming lines. And then parang sobrang laki niya, parang bigger than a yellow pad. Because I thought parang in accounting, these are the types of papers that people usually use. But honestly, in my stay in BAA, I've only used the worksheet siguro like 3 times. Like one for chapter 4 quiz in BA 99.1. And then in 116, we were required, so basically advanced accounting, and then in 118. So, and honestly, it's helpful, but then it's a bit procedural, so medyo madugo siya gawin. But we'll try to go through it because again, as making sure that we have solid foundation, we want you to master the worksheet because maybe on my end it doesn't work for me. I prefer the adjusted trial balance, but for other people na they really love like organizing their data, maybe the worksheet is for them, right? So basically, the overview of the worksheet will be as follows. So basically, number 1, we prepare a trial balance on the worksheet. So 2 columns will be allocated to our unadjusted trial balance, right? The second would be we enter our adjustment data. So again, the next 2 columns for adjustments will be allocated to our adjusting entries. So now that we have the unadjusted trial balance plus the adjusting entries, we can then create our third step, which would be our adjusted trial balance. So columns 5 and 6 would be allocated for adjusted trial balance. And then the next 4 columns would be columns 7 and 8 would be income statement, and then columns 9 and 10 would be statement of financial position. And then definitely kindly take note that all of our account titles will be on our leftmost side, and then in terms of the account titles, we refer to our chart of accounts, right? So again, this is very procedural, and in any type of procedural things, it would be better to look at it from the lens of our case study. So we're gonna go back to our 3.1 comprehensive problem, si Kuono Consulting. So I'll give you a moment to hopefully you can check back your exercises 3.1. so that you can take a look at our problem. So again, looking back at Kono Consulting, basically ang binigay sa atin would be the unadjusted trial balances and then some pertinent data with regards to entries that would affect our accruals and deferrals, right? So kindly get your Kono Consulting so that you can follow our worksheet process. Okay. So moving on, basically, again, this is our worksheet, right? So if you have like a columnar, physically, this is what it would look like, right? So again, column 1, or on the left-hand side on your grid, you'll have your accounts. And then as you can notice, we're using chart of accounts data, right? The next 2 columns would be our unadjusted trial balance. Columns 3 and 4 would be adjusting entries. And then columns 5 and 6 would be adjusted trial balance. Kindly take note na this is just one portion. I cut out the income statement and the financial statement so that we'll be able to focus on the first 3 steps of creating our worksheet. Okay. So now that we're clear with the format, let us go to step 1, which is basically the simplest thing to do is to plug in our unadjusted trial balance, right? So luckily, in the Kono Consulting, they already gave us the trial balance. So no need to create the initial journal entries. No need to post because everything is contained in our unadjusted trial balance. So again, we just basically plug it in. So first, we plug in our we plug in our assets, right? As you can notice, from cash, 101 cash, to 150 accumulated depreciation equipment, all of them are in the hundreds. And going back to our chart of accounts, this is by design, right? So basically, for this particular company, they wanted to make sure that all of their assets are in the hundreds, right? So basically, we plug in our assets both in the debit and the credit. So we plug in our cash, our accounts receivable, our supplies, all the way down to our accumulated depreciation equipment. But currently, it's at 0, right? Because this is the unadjusted trial balance, right? Then, from there, we then plug in our liabilities represented by the 200s. So 201 accounts payable all the way to 212 salaries and wages payable. So we just, again, plug it in. So plug the credits. So 45 accounts payable, unearned service revenue, 2,000. And then, third, we plug in our equity. So what represents our equity? Basically, our Kono capital and our drawings. So we plug in our credit of 18,700 in the credit and then 1,000 in the drawing, right? Debit. Then finally, all of the income statements, right? So the 400s represent your service revenues and then your 600s and above represent your expenses, right? So basically, we plug in our revenues and expenses. So plug in 95 service revenue, 64 salaries, wages, and expense, and then rent expense at 900. So now, basically, we just make sure that everything balances, right? So 34,700, 34,700. Both the debit and the credits are equal, right? So this ends the first step. So are there any questions? So kung wala, we proceed to the second step. So basically, we plug in our adjustments. So again, basically, you analyze first the transaction data. And then after analyzing in exercise comprehensive 3.1, we were able to come up with 7 adjusting entries, right? Comprising our deferrals and accruals. And then basically, we focus our attention to our adjusting entries column, right? So we do it again per entry. So journal entry number 1, supplies expense, debit supplies expense 900, credit supplies 900, right? So we plug it in. 2, utilities expense, debit 250, accounts payable, credit 250. So basically, we're just plugging it here in the second group of columns, right? Adjustment 3, debit insurance expense 150, right? 150. And prepaid insurance of 150. Number 4, unearned service revenue of 1,600 and service revenue of 1,600, right? Journal entry 5, salaries, wages, and expense. Basically, that's debit 1,104. And then salaries and wages payable, credit 1,104. And then the last two journal entries would be debit depreciation expense and credit accumulated depreciation equipment. Again. Accumulated depreciation is a contra asset to your equipment. Never natin gagalawin si equipment until we sell it. So if you don't sell your equipment, it should always reflect its historical value, how much you bought for it, how much you bought it, right? So 11,400. And then we only adjust, the way we adjust the equipment value is by highlighting our contra asset account accumulated depreciation equipment, right? So if this is a debit, then this is a credit, and that therefore it will lower the amount, right? So again, super important to highlight. And then finally, the seventh journal entry would be debit accounts receivable 170, credit service revenue of 1,700. So as you can see in service revenue, we affected it 2 times. So in essence, this could also be written as 3,300. But I just wanted you to see or appreciate that everything has a balance in terms of like your debits and your credits, right? So everything in terms of your adjusting entries equate to 5,894 in adjustments to your both your debit and your credit. So finally, the last step for this first phase is to plug in our adjusted trial balance, right? So basically, again, we look at our assets. So basically, we just add the debits, and then if it's debit credit, we subtract, right? So basically, we look at our updated asset accounts, right? So again, accounts receivable, it increased by 1,700. So now from 6,000, it became 7,700. In contrast, our supplies from 1,900 went down to 1,000 because we recognize a credit of 900. So we know that assets have a normal balance of a debit, and credits signify that it is a decrease. And therefore, an initial debit of 1,900 adjusted with a 900 credit will give us 1,000 debit for supplies, right? And then similar concept with our prepaid insurance. So debit 3,600, we added a credit of 150, meaning 3,600 minus 150 will give us the new balance of our 3,450 in debit. And then the next step is plug in our liabilities, right? So again, our accounts payable from 4,500 na credit because that's the normal balance for liabilities. Since my credit na 250, 45 plus 250, we get our new credit at 4,750. Inversely, our unearned service revenue from 2,000 credit, we introduced or adjusted for a debit of 1,600. So the normal balance of a liability is a credit. Since this is a debit, babawasan natin si 2,000. So 2,000 minus 1,600 is equal to credit of 400, right? And then basically salaries and wages payable, we just reflected the accrued expense here, right? And then we basically just plug in our equity accounts, capital and drawings. And then finally, our income statement accounts. So our revenues all the way to our expenses, right? So ultimately, when we add 34,700 plus 5,894 from the second group, you'll have 40,594, right? But then, as you can see, it's 37,944 because I wanted to highlight the fact that some of these accounts, they decrease their debits or credits. So basically, the reason why it's not 14,594 but 37,944 is because, for example, our supplies, hindi naman natin in-add si 900 but we subtracted it. And therefore, that would account for the differences. So the reason why I brought this up is because some of my classmates and even me, when I was doing the worksheet, I anticipated na 34,700 si unadjusted trial balance, 5,894 si adjusting entries. My adjusted trial balance should have a debit of 40,594. That's incorrect, okay? Meaning, wag kayo magpanic if it doesn't balance to 40,594. Because again, there are certain accounts that rather than increase them, binabangga against them. So 19 became 1,000, right? 36 became 450. Alternatively, in credit, si unearned service revenue, 2,016 naging 400, right? So make sure lang na every column, na every group balances. Meaning, in the first group, 34,700 is equal to 34,700. In the second group, 5,894 is equal to your debits and credits. Then now, 37,944 is equal to your debits and credits, right? So that said, we're done with the first phase of our worksheet. So now, let's move on to the second phase. So again, I cut na the unadjusted trial balance. I cut already the adjusting entries. So this is our third column, which is our adjusted trial balance, right? So now that we're done with our adjusted trial balance, similarly to our process, the next steps would be to figure out what are our income statement accounts and our statement of financial position. So step 4 is that we create our income statement, right? So in essence, we want to create the income statement for Kuno Consulting. And how do you do this? Using the adjusted trial balance. Basically, we just look at the income statement items under the worksheet. So conveniently, yung service revenue all the way to utilities expense are nasa baba ng worksheet, right? So we just reflect them. So if this is credit then dito, right? So we just copy. So basically, sobrang procedural. You have this portion, you just copy it in the income statement, in the appropriate credit and debits, right? For your expense and revenues. And therefore, if you add your debits, it will total 9,894. So as you can see, it totals here. And then credit of 12,800. Now, you'll be wondering, okay, there's a problem. If we use these accounts, it doesn't balance. From the analysis, we can see that our debit side has missing account, right, of net income of 2,906, right? So if we were to subtract 12,800 minus 900,894, you will have 2,906, right? So we just reflect the net income here. 12,800, 12,800. So by plugging, so basically after you copy this, you'll be able to get the subtotal of your debits, your subtotal of credits, and whatever the difference is will be your net income, right? So net income. So clear, income statement column, right? And then finally, the fifth step is to create our financial statements, right? So similarly, we just look at from assets to your liabilities all the way to your equity. So we copy debit 3,500 all the way to 11,400, and then your credits 19,000 all the way to your 18,700 na Suno capital, and then your debit of 1,000, right? And then we total 28,050, 25,114. So now again, hindi na naman nag-balance, right? So ano yung difference? Yung net income. So si net income here, debit siya nung una. Ngayon, naging credit siya. So again, I understand. You'll be weirded out, right? Bakit nung sa income statement, debit si net income ng 2,906? Ngayon, credit siya na 2,906, right? Hopefully, our discussion in closing accounts will shed a light on this question. But in essence, parang this actually net income represents what we call our income summary, that pag pinagbangga mo si revenue and expenses, initially it will come off as debit. And then you will close that income summary debit to your owner's capital. And ultimately, that will turn that debit into a credit. So, kindly take note lang, procedurally, this is how it happens lang in the worksheet. Na sa income statement, if it's a net income, you'll expect a debit here. And then here, in the statement of financial position, it becomes a credit in order to make sure that it balances to 28,050, right? So you'll ask me, oh, okay, I get na we just copied all of these figures. But where did the escuno capital come from? Well, the escuno capital comes from three accounts, right? Our net income, which is a credit, our credit of owner's capital, and then our drawings, right? So in essence, this portion actually, by looking at these three accounts, you can derive your changes in owner's equity. You have your investment of 18,700, your net income of 2,906 credit, kasi credit. So it added or increased your owner's capital. And then your drawings of 1,000 na debit, right? All to get your 20,606. So in essence, that basically is our worksheet. So again, nothing new, nothing fancy, everything procedural. The only thing that's weird is that the income statement, we recorded the debit at 2,906, and then the statement of financial position naging credit siya. Parang nag-magic, right? So hopefully we'll talk about it na in the next learning objective, right? So actually, that ends our review of a worksheet. So again, the worksheet helps us into our periodic steps, right? So from preparing our unadjusted trial balance all the way to creating our financial statements, we know that in our arsenal, we have the worksheet to help us provide the financial statement info at an earlier date. But again, this is just completely optional, right? So again, context, optional in the form of the real world, right? So optional meaning accountants, they can opt to create a worksheet, they cannot opt to. Pag walang worksheet yung isang company, it's not as if parang BIR will sue them or parang they're gonna be fined by the Accounting Standards Board. Kasi again, it's an optional tool, right? But in the quiz or in the exam, if we ask you to create a worksheet, or if we request that your solutions come in the form of the worksheet, then please make sure that you know how to create a worksheet. Kasi ito yung medyo matrabaho part, right? Yun. So now that we're clear with worksheet, we can now focus on the remaining two steps of our accounting cycle, which is basically journalizing and post-closing our entries and preparing our post-closing trial balance. And in essence, that falls under our deep dive called closing the books. Before I go on to learning objective number 3, are there any questions or clarifications? If none, kindly thumbs up in the chat so I know that we can proceed. Okay. So actually, like what I mentioned, see chapter 3, see accruals and deferrals is the hardest part of the first 4 chapters. Chapter 4 actually parang chill lang. Madali lang siya. The only complications probably will arise in terms of memorizing or mastering the closing the books, and then the different kinds of journal entries that we'll talk about in the next few objectives. So worksheet, procedural. This is something that I expect everyone to get perfect. It doesn't take analysis. It's just memorizing the steps. So kindly make sure fully mastered your worksheet, right? So now, what do we mean by closing the books? So closing the books happen at the end of the accounting period. And basically, the main goal of closing the books is that we want to close the book because it ends our chapter right now or the given period. And then we want to make sure that when we open our books in the next period, our accounts are ready because we closed it properly, right? And in essence, the very first thing that we want to highlight is that in closing the books, the most important thing that accountants do is what they do is they close what we call our temporary accounts, right? So I understand you'd be wondering, so what do you mean by temporary accounts? So actually, there are two types of accounts. So you can categorize the different accounts, meaning your assets, your liabilities, your equity, broken down into your owner's drawings and owner's capital, your expense, and your revenue, right? So the six components of our expanded accounting equations, you can actually categorize them into two types of accounts, right? On the left-hand side, you have what you call your temporary or nominal accounts, right? The reason why they're called temporary or nominal is that, as the name suggests, it relates to only one given accounting period. Meaning, if I assess Apple, I assess Apple's performance based on the period. So again, Apple has a fiscal year of September to September year 1 to September year 2. Meaning, their revenues, their expense, and their owner's drawings is just contained per period. So basically, they earn like a revenue of 50 billion, right? 50 billion year 1. It doesn't mean that year 2, their revenue is gonna be 70 million, meaning the 70 million is like 20 billion this year and then 50 billion last year. No, that's wrong, right? Revenues are tracked per period. So revenues year 1, 50 billion. And then start of year 2, what's your revenues? 0, right? And then after year 2, I have like 40 billion, right? So again, therefore, what I'm highlighting is that revenues, expenses, owner's drawings are temporary accounts and they only relate to one given accounting period. And therefore, we have to close them. And what I mean by close is that we have to, at the end of the period, zero them out, right? We have to zero out our revenues, we have to zero out our expenses, and we have to zero out our owner's drawings. Okay, clear? So those are for your temporary accounts. Now, let's go to the right-hand side, right? So if there are temporary accounts, obviously, there would be permanent accounts or what we call the real accounts, right? And the real accounts relate to 2 or more future accounting periods. So we don't close out the following accounts. We don't close out our assets, we don't close out our liabilities, and we don't close out our owner's capital, right? Meaning, we just update them, right? So we update assets, we update liabilities, we update owner's capital. Meaning, for example, cash. So again, I decided to run like a cake business, right? So one of my assets would be cash, right? So cash in year 1 is let's say 1,000 pesos, right? Cash in year 1. Pag walang nangyari sa akin, cash in year 2 is still 1,000 pesos, right? Pero for example, second scenario, cash in year 1 is 1,000. I was able to sell something, naging 3,000. Now I just update it at the end of the period so that my year 2 beginning balance would be 1,000 plus the additional 3,000 would be 4,000, right? So again, your assets, your liabilities, and your owner's capital, they don't zero out. They just get updated. We have to make sure that we update these permanent accounts. We don't close them out, right? So again, in summary, you can categorize all of the accounting components into 2 types. Your temporary accounts, or what you call your nominal accounts, that relate to only one given accounting period. And therefore, what we have to do for temporary accounts is that we have to close them, meaning we have to zero them out. And what are the temporary accounts? Our revenue, our expenses, and owner's drawings. So in a sense, you can look at it that your income statement and most of your changes in owner's equity are temporary accounts, right? So temporary accounts. On the other hand, you have your permanent accounts or the real accounts that relate to 2 or more future accounting periods. So for them, we don't zero them up, we just update them, right? So the permanent accounts, you can look at it as your balance sheet items, your assets, your liabilities, your owner's capital. So again, this is out of all of the slides for closing the books, this is one thing that we have to master theoretically, right? So now the question is, so how do we actually close temporary accounts, right? Parang sounds scary, right? Parang, is this something gonna be complicated? Well, honestly, it's not. I feel like we already know, if you've mastered financial statements, then roughly you have an inkling or parang have a good feel on how to close our accounts, right? So looking back, like what you've mentioned, all of our financial statements are interrelated, meaning our income statement usually gives us net income and net loss. And then we carry over our net income and net loss to our changes in owner's equity. And then from here, this changes in owner's equity helps us derive our ending capital. And then the ending capital is the thing that we carry over to our total equity or ending capital that would be reflected in our balance sheet. So basically, like what I've mentioned, you can treat most of the accounts under income statement and changes in equity as your temporary accounts, and then your balance sheet as your permanent account. So to clearly illustrate this further, let's look back at Kuono, right? So Kuono, income statement, right, is broken down into your income, your expense, and your net income. And then using net income, we carry over the net income so that we complete our statement of changes in owner's equity, right? So 2,906. And then ultimately, we create our balance sheet wherein we carry over naman our ending capital. So we get net income so that we can carry over it to our changes in owner's equity. And then by doing so, we'll able to arrive with our ending capital for Escuno. And then we carry it over to finally our financial possession. So in a sense, you can appreciate na all revenue and expenses, ultimately, they are reflected in your net income, which is then carried over to our additions to owner's capital. And then ultimately, these are just a portion of what comprises our ending capital. And then ultimately, ang magiging permanent account na lang natin is the ending capital of Kuono. So in summary, when we created this financial statements from income statement all the way to statement of financial position, technically we did the closing of the books, right? So step 1, we close all revenue accounts, 12,800, and we closed all of our expense accounts, 7,504 all the way to 150, to our net income, right? And then yung net income natin, we closed it to our owner's capital. And si drawings also, we closed it to owner's capital. And then ultimately, we were able to determine the ending capital, which is the permanent account, right? So it sounds complicated now, but it's actually going to be easier when we look at it from a journal entry perspective, right? So basically, in order to close the books, we create closing entries, right? Obviously. So honestly, if nalito pa rin kayo dun sa explanation, I think by mastering the 4 closing entries, so basically this is something that you can memorize procedurally, you'll be able to appreciate the full accounting cycle. So, but before anything else, let's take a step back and understand ano nga ba yung closing entries, right? So closing entries are required, okay? Required at the end of the period. And basically, what they do is they help us close our temporary accounts to owner's capital, right? So basically, in summary, we close temporary accounts to owner's capital, meaning by doing our closing entries properly, we're able to zero out our revenues, zero out our expenses, and zero out our owner's drawings portion of our capital, right? So they are usually made on the last day of an accounting period. So alam nyo na, last day of an accounting period, first thing you'll do, mag-adjusting entries kayo, right? And then from there, you create your adjusted trial balance. And then don't forget, may second step pa. You create your closing entries. So now, let's take a closer look on how to actually close our books. So again, it's comprised of 4 steps. But for the first part, let's first focus on our first 2 steps, which would be number 1, close our revenue accounts, and number 2, close our expense accounts to an account that we'll call the income summary. But first things first, let's start off looking at our income statement and creating our T accounts for revenues and expenses. Now, kindly note that the T accounts all revenues and the T accounts all expenses are just illustration purposes. Kindly note that all of your T accounts should always still be per type, meaning that for salaries, wages, rent, supplies, expense, you'll have different T accounts. So roughly for this particular example, you're expecting to have at least 6 different T accounts for expenses. But for simplicity's sake, given that our focus is to understand the closing procedure, we just bulk them up to what we call all expenses. Okay? So this is just for illustration purposes. So now that's clear. Again, the very first step that we have to do is from your income statement, just plot out or plug in your revenues. So service revenue of 12,800 would be credit, right? And then you'll have your debits for your salaries, wages, and expense, your rent expense, your supplies, your utilities, your depreciation, your insurance expense. And then from there, you'll be able to get their subtotals, right? So 12,800 for your revenues, and then 9,894 for your expenses. So actually, this is still accurate with our income statement. So 12,800, 12,800, 9,894, 9,894. So now, the thing that we have to do is to close them to income summary. And in order to close an account, you have to zero it out. Meaning, since all revenues have a credit normal balance, we have to recognize a debit. Okay? And then, for expenses, since they have a normal debit account, what we have to do is to make credits in order to zero them out. And then the remaining portion, we reflect in our income summary. And therefore, we introduce our third account, which would be the income summary, wherein all the closing will happen for our revenues and our expense accounts. So now, let's proceed to step 1. First is close out revenues, right? And as I mentioned, we have to zero out our revenues. And therefore, we recognize a debit in revenues of 12,800. And given that it's a double entry accounting system, if we created a debit for revenue, we have to create a credit in income summary. And therefore, in essence, what we did was to zero out our revenues. Given that we have a credit of 12,800 against the debit of 12,800, our revenue is practically closed. So zero, this is zero. And now income summary has a running balance of 12,800. So meaning that in terms of our correcting journal entry now closing, so meaning that our closing journal entry number 1 would be debit service revenue of 12,800 and then credit income summary of 12,800. So now that we're clear, let's do the same exercise now focusing on our expense accounts. So basically, we credit 7,500 for salaries, we credit 900 for rent, we credit 900 again for supplies, we credit 250 for utilities,
we credit depreciation for 190 and we credit for insurance of 150, right? And if we subtotal, we can have a subtotal. In essence, we did 9,894 worth of credit, right? And therefore, our expenses are also zeroed out. And therefore, our income summary now has a debit of 9,894. And this actually helps us create our second closing entry, which is debit income summary of 9,894 and then credit all the various expenses for the period, from your supplies expense, your depreciation expense, all the way to your rent expense and utilities expense. And then ultimately, that will show you that in essence, your income summary has a total credit of 2,906, which would represent your net income. So simply, the first two journal entries would be, again, close revenue accounts using debit service revenue, 12,800, credit income summary, 12,800. And then the second journal entry would be debit income summary of 9,894 and then credit the various expenses. And then if you look at this directionally, in terms of our income summary, it will reflect our net income, which is already shown in our income statement. Let's proceed to the last two steps, which would be to close our income summary and our owner's drawings to our owner's capital. So again, we begin by looking at our statement of changes in owner's equity, right? And then the T accounts income summary and owner's drawings. And in essence, we just try to find the relation to this. So for example, the net income of 2,906 is actually there, reflected already in our statement of changes in owner's equity. The drawings of 1,000, we plug in as a debit to our owner's drawing T account, right? And therefore, we have our ending balance of a credit of income summary and a debit of 1,000 for our owner's drawings. Now that we're clear, the next step is to close them to our owner's capital. And how do you close again? We zero out our income summary, we zero out our owner's drawing. So let's first focus on our income summary. So in total, our income summary has a 2,906 credit balance. And therefore, in order to zero this out, we need to create a debit of 2,906. And in owner's capital, since debit's income summary, the 2,906 would then be a credit in owner's capital, right? And therefore, what happens is that income summary is zeroed out or close to owner's capital. So the journal entry for this would be debit income summary of 2,906, credit escudo capital 2,906, right? Now let's move on to the last step, which would be to close our owner's drawings of 1,000. So again, the normal balance of the owner's drawings is a debit, and therefore we have to credit 1,000 in order to zero this out. But then the credit of 1,000 is a corresponding debit in the owner's capital of 1,000. And therefore, we zero out drawings and we close it to owner's capital. So 1,000 debit, 1,000 credit, 0. Represented by the last journal entry, debit escudo capital debit 1,000 and then escudo drawings credit of 1,000, right? And in essence, by subtotaling everything, you will arrive with your ending capital of 20,606, which would be your permanent account reflected in your balance sheet, right? So again, these are the two journal entries for the last part of closing the books. And as you can see, the owner's capital is properly closed at its ending balance reflected in the changes in owner's equity, which is also transferred in our balance sheet statement. So in essence, these are your 4 closing entries. Again, number 1, you close your revenue to your income summary. Number 2, you close your expenses to income summary. And then you compare the two. So you have 12,800 and 9,894. So in essence, what you have is a credit of income summary of 2,906, which we will close again and therefore recognize a corresponding debit income summary of 2,906, which will be close to your capital as a credit of 2,906. And then finally, you close your drawings by debiting capital of 1,000, crediting drawings by 1,000. let's look at it from another perspective. So again, in summary, these are the 4 steps, right? So close revenue accounts, and then close expense accounts to our income summary. And then we have to zero out our income summary to reflect it to our owner's capital. And then finally, we are gonna close our owner's drawings also to owner's capital. So everything leads to owner's capital in order to make sure that our revenues, our expenses, and our owner's drawings are zeroed out and then properly reflected in the ending capital of the company. So using our T accounts from before, let's again, one last time, walk through the whole closing the books process. So first, what we did was we closed our revenue accounts by creating debits in revenue. So 12,000 debit in revenue, which then is translated to a credit in our income summary. And then in our second step, we basically close our expenses by crediting all of our expenses and then debiting all of those in the income summary. The third thing that we wanted to do was that now that we know that there's a credit balance of 2,906, in order to close this out, we need to recognize a debit of 2,906 in our income summary to zero it out, and then transferring that into our owner's capital in the form of a credit of 2,906. And then the last step would be to close our owner's drawing by recognizing a credit in owner's drawing, which is represented by a debit in owner's capital. That ultimately, everything, the revenues, the expenses, the owner's drawings, all land into our owner's capital equation to give us our ending capital of 20,606, which would be a permanent account. So in essence, i-memorize nyo lang yung closing entries. So the good thing about this is that these 4 entries are very procedural and it applies to any kind of company and any kind of period. So as long as you master the process, then you don't have anything to worry about when it comes to our closing entries, right? So if everything's clear, we move on to our learning objective number 4, which is understanding our post-closing trial balance, right? Okay. So there's a question. For quizzes and exercises, would we be required to create T accounts for every expense revenue account in the portion of creating closing entries? So in the quiz, honestly, if closing entries yung hinihingi, we just are asking you to create your 4 closing entries. So ang expectation is you know or you master the 4 closing entries. For T accounts, it's still the same as before na you make sure na whenever you post, the T account should be per expense category and per revenue category. So mostly T accounts, honestly, are just solutions eh. Ang mas hinahanap is either the financial statements or journal entries. But syempre, it helps na your T accounts are in order. Okay? I hope that answers the question. Thank you for that question. So now we move on to post-closing trial balance, right? So may tatlo na tayong trial balance. Unadjusted trial balance, adjusted trial balance, and then post-closing trial balance, right? Si post-closing trial balance, basically, it just shows or proves the equality of our permanent account balances forwarded in the next accounting period. So actually, mas maiksi si post-closing trial balance. So this is an example of your post-closing trial balance. So as you can see, it just contains your assets represented by your cash all the way to your accumulated depreciation equipment, and then your liabilities of accounts payable and unearned service revenue, and salaries, wages. And then you only have one owner's capital because we closed our revenues, we closed our expenses, and we closed our owner's drawings kay Escuono Capital at 20,606. So if we had to look at the ghost of the adjusted trial balance, you'll notice na from all the way from drawings, C302, to your utilities expense of 732, all of them were zeroed out, right? And then ito na yung tamang balance of your debits and credits. 27,050 and 27,050. So again, post-closing trial balance only shows permanent accounts and they don't anymore show temporary accounts. So if we request a post-closing trial balance, it's okay to just show the short form, right? Meaning you can show this, right? Kasi medyo hassle naman to write all of these accounts only to show na zeroed out sila, right? So meaning if we request for a post-closing trial balance, you can, option 1, you can provide this. Or if you're using a worksheet, since may accounts na kayo, you can use this longer form. Yeah. So it's just options, right? Pero ito lang, mas maiksi si post-closing trial balance, right? So again, the post-closing trial balance ends or closing the books cycle, right? So again, in summary, I want you to memorize the temporary accounts. Revenues, expenses, owner drawings are what we call nominal or temporary accounts. They relate only to one given accounting period and therefore we zero them out. Permanent accounts, on the other hand, we don't zero out, we update, right? Because they relate to 2 or more future accounting periods. So for the sake of comparability, we have to make sure that we update them. We don't zero them out. So we don't zero out assets, liabilities, owner's capital, or the balance sheet items, right? So that ends our full accounting cycle. Like, so we've cleared level 4, and let's just take a look back to summarize. So again, analyze business transaction, step 1. Journalize the transaction. We're done with that. Post to ledger account, we know that already. Posting to ledger accounts, this is something that we already know. So basically summarizing it. Prepare an adjusted trial balance. So we create an adjusted trial balance from our initial entries. Then we recognize any adjusting entries, be it a deferral or accrual. Then finally, we create our adjusted trial balance, the second form of our trial balance. So we update the unadjusted trial balance. And then we prepare our financial statements. And then the last 2 steps, the one that we just recently discussed, we post our closing entries. So basically our 4, so kindly memorize them. And then prepare the post-closing trial balance, right? So again, this is just for appreciation, to show you that the temporary accounts are zeroed out and the permanent accounts are just updated, right? So that ends our accounting cycle for the given period. So again, as the name suggests, it's a cycle. So we do it for every period. So after your post-closing trial balance, you're now ready to open your books again and then analyze the business transaction of the next period. And then you go over the whole cycle again and then close, open, all the way until, perpetuity. Hoping that the company is, very successful economically, right? So honestly, that ends our crash course of the fundamentals of accounting. So actually, I think for some STEM classes, it ends with the full accounting cycle. And so chapter 4 would be the benchmark. So after this lecture, this is where parang we will take it a next level harder. Wherein we're gonna be taking a closer look at specific accounts. So particularly inventory in chapter 5. So please make sure that from chapters 1 to chapters 4, you solidify your foundation. If there's something unclear, if there's exercises you want to solve, kindly let me know either through email or kindly let me know through the Facebook group so that either we discuss it in class if may extra time tayo, or we can schedule like a group consulting session outside class hours, right? So I say that as if parang tapos na tayo with today's lecture. But honestly, may dalawa pang pahabol. But this is just the parang filling in the gap. So out of the basic fundamentals of accounting, what are the other things that we haven't discussed? So basically, learning objective number 5, we discussed lang or summarized the 4 different journal entries. So when I say different journal entries, definitely there's a normal journal entry wherein every time you have a transaction, you create a journal entry. But then there are 4 different journal entries aside from your initial entries, right? And as you know, you're already familiar with 2 of them. Adjusting entries, closing entries. Kaka-discuss lang natin, right? The other 2 would be what we call reversing entries and correcting entries. So the reason why I wanted to split them up in such a way is that I want you to know that adjusting entries, closing entries are required. Okay? Required tong dalawa. Reversing entries are optional. Reversing entries are optional. Correcting entries only happen when you make a mistake. So this is very avoidable, right? So if magaling yung accountants nyo, wala kayong correcting entries. Pero kung parang nangangapa pa, or parang nag-start pa lang, you'd expect na may correcting entries, right? So again, we just finished our closing entries. So again, closing entries, they're made up of 4. So ang maganda kay closing entries, they're all the same 4 closing entries every period, regardless of the company. Just make sure to memorize the arrangement. Number 1, close your revenue accounts to your income summary. Close your expense accounts to your income summary. Now, you compare your income summary of 12,800 and your income summary of 9,894. It will give you your current credit income summary of 2,906. Since credit siya, we want to zero out income summary. So we debit income summary of 2,906 to capital. And then si drawings, we close out to capital also, right? So that's closing entries. Adjusting entries, we've already been mastering this since last week. So again, we have 2 types: deferrals or prepayments, signified by unearned revenue, prepaid expenses, supplies consumption, and equipment depreciation. So in the format, this is directionally correct. So this is something na, kung hindi nyo talaga magets, this is something you can memorize as long as you're able to determine kung ano yung accounts being talked about, right? And then you have your accruals represented by your accrued revenues and your accrued expenses, such as your salaries payable and interest payable. So done. 50% we're done with the different journal entries. The next 2 are just other accounts that are equally important to master, but then again, they're not required, right? So let's first go to reversing entries. So reversing entries are optional, right? So they're optional at the start of the period, right? So they're created at the first day of an accounting period in order to simplify recording of transactions. And reversing entries are actually very niche in their use. What do I mean by that? You only create reversing entries for accrual entries. Accrual, right? Not deferrals. So again, adjusting entries are broken down into deferrals and accruals. For reversing entries, we only care about accruals. So what are our accruals? We have our accrued revenues, wherein we have an adjusting entry called as debit asset credit revenue. Like for example, an AR, di ba? Accounts receivable, debit, cash, accounts receivable, debit, service revenue, credit, right? An example of accrued revenue, right? For accrued expenses, we have debit expense, credit liability, salaries and wages expense, debit, credit, salaries, wages, and payable, right? So basically, as the name suggests, this happens at the end of the period. So this happens at the end of the period. So after we close the books, it's a new period, first day of the accounting period, we reverse them. Meaning, literal, i-reverse mo. Si revenue, credit siya, debit na siya now. Si asset, debit siya, credit. So the reversing entry for accrued revenues would be debit revenue, credit asset. Next, accrued expenses. Expenses was debit. So now expenses should be credit. Liabilities is credit. Liability is now debit. So now the reversing entry for accrued expenses would be debit liability, credit expense. So to further appreciate this, let's look back in Kuono Consulting. And in Kuono, number 5, it said May 31 is a Wednesday and employees are paid on Fridays. So now, basically, naputol yung work week, right? So he pays 1,840 for 2 workers. So we divide it by 5. So we know that it's 368 per day. And then in the period that we're in, we only incur 3 days worth of liabilities and expense. So 368 times 3 is 1,104. So debit salaries, wages, expense, 1,104. Credit salaries, wages, and payable, 1,004, right? So in this 5-day work week, 3 days is something that we already recognize. The last 2 days is a problem that we'll encounter in the next period, right? So basically, to appreciate reversing entries on how they simplify the recording process, let's look at it from 2 approaches, right? Let's look at it na on the left side, we don't use reversing entries. On the right side, we use reversing entries because at the end of the day, reversing entries are optional. So first, kay Kuono, let's look at the previous week expense, right? So in May 26 raw, Kuono paid his 2 employees for the 3rd week of May for 920 each. So the journal entry here would be 920 times 2. Debit salaries and wages expense 1,840. Credit cash 1,840. So we incurred an expense, but then there's no problem. We paid for it already, right? So expense cash, very straightforward. Now the complication arises in May 31, wherein the 4th week of May actually was broken down into 2. Na May 31 is a Wednesday, so 3 days lang i-recognize natin na liability. And that was what we discussed in the previous slide. So we know that the adjusting entry for this is that there is an expense of 1,104 debit and a credit of a salaries, wages payable of 1,104. So same treatment so far, right? And then finally we close the books. So we basically just assume that the total wages expense is 6,624. So we basically credit the expense 6,624. We close it to our income summary, right? So the first 3 transactions, pareho pa lang, same approach, regardless kung reversing entries or not, right? But then the major difference happens in June 1. In June 1, books are open for the next period. So you have 2 options. You can opt not to make a reversing entry because, hassle gawin. Or you can create a reversing entry. And basically, as you can see, it's just basically baliktad, right? So debit, salaries, wages payable, 1,104. Salaries, wages, and expense of 1,104. So now, the promise of reversing entries is that it should simplify the journal entry, right? So what does that mean? Actually, we'll be able to appreciate it when we go to the last transaction here, which is June 2. So come Friday, you have to pay your employees, right? Now, again, the 5-day work week was broken down. Last period, you accounted for 3 days worth. So mayroon ka ng liabilities of 3 days worth. And then the remaining 2 are expense for this period, right? And therefore, the compound journal entry without the reversing entry would be salaries, wages, expense 736 to recognize the expense for 2 days, meaning the Thursday and the Friday. And then debit, salaries, wages, and payable representing the liability of the previous period, meaning the Monday, Tuesday, Wednesday, until May 31 of 1,104. And that was what you gave in cash, right? Which is credit cash 1,840. So this is the one that has no reversing entries. Dito naman, dahil ni-reverse natin si payable, it's just very clean. Salaries, wages, expense 1,840, cash 1,140. Similar to what we did for May 26. So again, you can appreciate that by using a reversing entry at the start of the period, we were able to simplify the normal entry compared to if you don't use the reversing entry, hassle to make a compound journal entry, right? So honestly, for those who are starting out in accounting, they love reversing entries because it lessens the complications. Now, people using advanced accounting, since it naturally comes into their head, like they get the compound journal entry, they opt not to use the reversing entries. So again, there's something you need to memorize. This is again something you need to memorize. Reversing entries are only for accruals, and literally you just reverse your accrual entry for your accrued revenues and your accrued expenses. 3 down, 1 to go. The last one would be our correcting entries. So correcting entries are avoidable entries. So basically, in terms of timing, hindi na tayo maghihintay until the last day of accounting. Pag may nakita kang mali, i-correct mo na kagad, right? So avoidable entries, so correct as soon as you can. So it affects a combination of accounts depending on the error. Unlike accrual entries, where adjusting entries where it affects one income statement, one balance sheet statement, right? So to appreciate this, let's look at it from an example. So basically at Raymond Ltd, they had a newbie accountant and they found out that there were some entries that were incorrectly created. So there were 2 journal entries. There were 2 journal entries made and there were 2 errors found. So basically, let's look at it on a per transaction basis. So in essence, the way to create correcting entries, ang problem is correcting entries, and this is the bulk of the mistakes of chapter 4. Correcting entries is not something you can memorize. Correcting entries will come from analysis, right? The only way I can help you is to lay out the 4 steps in order to create your entries. So step 1, analyze the entry made. So what is, right? So what is the account or the entry that was made? It said na it was debited to cash 870, credit service revenue 870. So madali lang. You just create the journal entry based on the given. So debit cash 870, credit service revenue 870. Next is, we have to determine the correct entry or what should be, right? So from what is, what should be. And what should be is that a collection on account from a customer of 870 should be debit cash of 870, credit accounts receivable of 870, right? So this is the incorrect entry, what is. The correct entry, what should be, is debit cash 870, credit accounts receivable. Third step is analyze the understatements and the overstatements, similar to what we did with adjusting entries. And we know that what happened. Cash is okay, but our service revenue should not have been recorded. And our accounts receivable should have been decreased. And therefore, we know that our revenue right now is overstated and our receivables are overstated. Therefore, this analysis will help us to create the adjusting entry, the correcting entry, which is we have to lower service revenue by debiting service revenue of 870 and then lowering accounts receivable by 870, right? So basically 870, 870. Moving on to the second one, the purchase of store supplies on account for 1,510 was recorded as debit to supplies 1,150. So now, this is a more complex mistake. Not only did they make wrong accounts, the values are wrong. 1,510 versus 1,150. But then, the framework still stays the same. Step 1, what is? Basically, what they did was debited supplies, credited accounts payable for 1,150. That's incorrect in two ways, right? What should be was that they should have debited supplies, credited cash for 1,510, not 1,150. So if you analyze the understatements and the overstatements, there are 3 accounts that are affected. Your supplies are understated because you recorded 1,150 when in fact it should be 1,510. So it's understated, your supplies. Your cash and your accounts payable are both overstated. Dinagdagan mo si accounts payable when hindi naman dapat, and si cash, hindi mo binawasan ng 1,510, right? So now, it looks like a complex problem. But honestly, correcting entries are simpler if you do a 2-step thing, which is step 1, reverse the wrong entry, meaning just literally reverse it, like undo the entry. Meaning debit accounts payable, credit supplies 1,150. So this is the reverse of the wrong entry, and then just make the right entry. So copy the correct, right? So debit supplies 1,510, credit cash 1,510. So that's the simpler. Reverse the wrong entry, make the correct entry. Or you can make a compound journal entry wherein you just analyze that what you have to do is to debit accounts payable in order to correct the overstatement, debit supplies to correct the understatement, and then credit cash to correct the overstatement. And then the 360 was computed by the should be supplies is 1,510, but the supplies now is 1,150. So 360 yung debit. So actually that ends our correcting entries. Again, these are just avoidable entries and you only create them as soon as an error is discovered. So these are our 4 different journal entries: our adjusting, our closing, our reversing, and correcting. So actually, the last learning objective is that we are now going to try to appreciate what we call the classified balance sheet. So going back to our very first lesson, I hope now that you have a newfound appreciation on why I see accounting like a universal scorecard. Because of our frameworks, because of our principles, we know that it's conceptually consistent, right? And we know through our journal entries and our different journal entries that similar transactions are treated the same way. And regardless of what type of company you are, as long as you follow the same financial reporting standards, you can then have an objective way of assessing and comparing businesses. And ultimately, the importance of accounting is that we provide transparency, meaning that there is a minimum amount of disclosures required. So you're sure that the data is material, and that comparability, that you can assess the financial performance, the financial position of the companies by comparing their financial statements. And therefore, for businesses that run the world, it is essential to have accounting because it's essential to have a scorecard. And in particular, the more information you have, the more power you wield, right? Meaning that even though you're not accounting majors, it's super important to understand accounting because this is a new way to digest information. And therefore, it will empower you to create next level business decisions, right? So even if you tell me your passion is finance, you tell me your passion is marketing, you tell me your passion is entrep, basic accounting knowledge will empower you by giving you more information, by giving you more power to create wiser decisions, be it in marketing, be it in finance, be it in anything business related. And therefore, logically, the more information our financial statements provide, the better, right? And therefore, if before, for basic accounting, we showed you the financial statements of financial possession, now we're going to be introducing the actual things used by companies called the classified statement of financial position or our classified balance sheet. And the basis for this is actually a reporting standard called IAS 1 or PAS 1 with the title Presentation of Financial Statements. And basically, it enhances the usefulness significantly. So bakit siya classified? Because it classifies accounts into significant groups. So right now, our example is JFC or Jollibee Food Corporation. And you can see that your assets is broken down into significant parts. Your current assets, your non-current assets, your liabilities and your equities classified in the same way. So because of this, we're able to get more information and we make more empowered decisions. So we can assess the availability of the assets to meet the debts as they fall due. We can see the claims of both the short-term or the long-term creditors on the total assets. And then it also improves the comparability. So now we can analyze a company in terms of their short-term performance and their long-term performance. So let's look at it per component. So assets are broken down into current assets and non-current assets. And basically, the main difference is that current assets, you expect to consume them within 1 year of the business operating cycle. So examples of current assets, cash, short-term investments, accounts receivable, inventory. Those are all current assets because you expect to sell them within 1 year or the business operating cycle. Meaning, you create inventory because for the operating cycle, you hope to sell them within that year. In contrast, non-current assets are consumed beyond 1 year or the business operating cycle. When you buy land, when you buy equipments, they not only affect one period, they affect all future periods, right? So property, plant, and equipment, intangible assets, and long-term investments are non-current assets. In liabilities, we have current liabilities and non-current liabilities. Now, current liabilities have a very strict definition, right? So, number one, it should be settled within the normal operating cycle. Or second, it should be held for the purpose of trading. Or third, it is due to settle within 12 months after the end of the reporting period, and with the fact that the business had no right to defer settlement. So examples of current liabilities would be accounts payable, the current portion of your long notes payable, etc., etc. Income tax payable, salaries, wages payable, utilities payable, all of them are current liabilities. On the other hand, non-current liabilities are those you expect to pay after 1 year or after the operating cycle. So basically, notes payable, derivative liability, etc., etc. As long as they're after 1 year, then those are non-current liabilities. Finally, for equity, so if you look at JFC's equity, you'd be like, parang wala siyang Jollibee capital or Jollibee drawings. Pero right now, it's more complex. They have capital stock, they have retained earnings, all of the things that we haven't discussed. So kindly take note that in 99.1, to make everything much easier, we're looking at it from the lens of a sole proprietorship, right? In 99.2, you'll talk about partnerships and corporations, right? So just take note that the equity portion changes depending on the business type. If sole prop, it's owner's capital. If it's partnership, different capitals based on the partners. And the corporation, you have capital stock and then reserves and retained earnings. And then finally, you have notes, wherein basically it enhances the information. So it provides additional information. So for example, you have notes on certain assets. Like for example, si JFC, sobrang importante. Parang Jollibee is heavy on inventory because of their food. Like, so parang if you want to have like notes on the Chicken Joy performance, that will be contained in your notes for your inventory. So that ends our classified financial statements, and in essence, actually, completes our accounting cycle. So congratulations everyone. We're finished with the fundamentals of accounting. So chapters 1 to chapters 4 is your crash course on your accounting 101. And this actually marks the end of our first phase for accounting. So before in the pandemic, this would actually mark the start of your long exam 1. And usually, sa long exam 1, ang pumapatay would be accruals and deferrals and correcting entries. And then, syempre, kung hindi nila gets yung, all of the recording process. So, kindly make sure na in chapters 1 to 4, you really master the foundations. Next session, Tuesday, we'll discuss chapter 4. But then tayo, since we only have 2 exams, we're gonna be jumping into inventory. And in inventory, doon yata maraming nalilito, nawawala. And nawawala sila honestly, not because hindi nila gets yung inventory, but because hindi maganda yung foundation nila. So again, may request for next exercise discussion. If meron pang hindi clear, if there's something you want to rediscuss, pag-usapan na natin now. Kasi pag hindi pa clear by chapter 4, by chapter 5, all the way until chapter 15, kakainin kayo ng buhay. Yeah. So with that said, are there any questions before I end the recording? If none, kindly thumbs up so that we know everything's clear on your end. Got it. So for next, so Tuesday, so reminders, we have a Monday quiz. Tuesday, deadline before class of exercises. I promise we'll revisit the closing entries with the proper reflected key accounts on the before we discuss the exercises. So if there's none, I'll formally end the recording. Thank you so much, everyone.